Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. All right, markets rallying back pretty strongly yesterday. Tech recovering, investors obviously digesting the lower inflation. We also saw PPI come out lower as well. And then we also had today the Fed's Bostic advocating for a pause in rate hikes after one more hike. So just kind of confirming what the market's already thinking is the most probabilistic outcome. Metals were strong again. Gold is just shy of all-time highs now. So again, silver was firm, gold and also copper having a bit of a rally too. And then energy sector still a little bit not quite as strong, pulling back, taking a bit of a breather. Oil down about 1% and nat gas still down 3%. Right, nat gas still sitting on the near the lows, unable to really rally. Uranium was up though, which so kind of bucking the trend in energy there. If you think of it, uranium as an energy commodity. Bank earnings today. Obviously, we got JP Morgan just came out, hit the tape. Very, very good earnings actually, and better guidance. So stocks indicating up 6% is dragging some of the other banks up with it. Bank of America up 2.5%. And then we've got retail sales later today as well, which will be interesting to see how that impacts rates, markets, and things like that. Volatility wise, we did see vols get slammed a bit. S&P vol down at 1.5, pretty punchy given where it already is. So a big shift lower there, mainly because the market rallied so much. You know, we're seeing 1.5 sigma moves in both NASDAQ and S&P. That's generally going to take vols down just as you float up the surface. But, you know, we have been mentioning that the street is kind of drowning in gamma right now. And so vols coming down is a bit of a symptom of that. The VIX touching 18 again, below that this morning as we speak. Meant to be a bit of a support level 18. We'll see if it can stay below there for long. But quite a key level here on the VIX to be watching for. Gold vols also firming as we're approaching those highs. If we do break those highs, a lot of people are calling for quite a lot more upside in gold. And then oil vols looking pretty cheap down on a 30 handle here. These are levels we haven't seen since before the Ukraine war. So really looking at sort of 1 year, 1.5 year lows in oil vol. Carry wise, we are seeing positive carry still in most places in equities, although it's reducing as the vols are coming down. And we are getting larger than expected spot moves in terms of the rally. And then commodities, only really oil in negative carry there as those vols are hitting the lows. And oil is still moving around, threatening for a bit of an upside break as well. But then in terms of the positive carry in commodities, really it's the gold miners that are providing the most juice at around 31%. In terms of skew, we are seeing skew softer generally across the board, again in equities. It does seem upside protection may be more needed, given that so many investors are still quite bearish, and given that the sentiment is quite low going into earnings. Precious metals skew is bouncing a bit though. So whilst we're making highs or getting close to highs in precious metals, people are bidding for protection, maybe thinking that it's a bit overbought right now. It might have a period of consolidation, so people trying to get some protection in against any longs there. So a strategy that we have been advocating in silver, buying risk reversals there. And then nat gas skew popping another 3 points back towards the highs. 98 percentile there as spot just cannot find a bid, right? Persistent spot weakness in nat gas. I think it's got to end at some point, but right now it just keeps falling, and the skew is at the highs again, reflecting the fact that there's no bid for this thing. Okay, now looking at fixed strike volatility. So this is a monitor that we run fairly regularly. See what's going on under the hood, what the market makers are doing, things like that in S&P. So we did flag, obviously, in yesterday's report that S&P realized has got very low, right? It got down to about 4 or 5. And we think it's because, dealers are all long gamma, long these strikes, local strikes, was making it hard for the market to move. Now, we did manage to get a sizable move yesterday of about 1.3% on S&P, right? Which was not what the sort of moves we've been seeing. And we think that was likely driven by zero DTE call buyers, as spot gamma hero indicator points out. The green line rising all day is basically these zero DTE call buyers coming in. Okay, so whether it's people hedging against short outright positions they've got, or whether it's fresh speculators, there was a lot of intraday kind of action there, taking the market higher. But then if we look at the other maturities, so we've got April, May, and June maturities here, and we look at the fixed strike surface, we are still seeing quite a lot of red there, right? So we're seeing anywhere sort of 4,000 and above, any strikes above 4,000 were getting offered. And getting offered in reasonable, like the weekly stuff's down about 30 basis points for the at the monies. The upsides are down half a vol to a vol. So we are seeing that as the market's rallying, and it's putting in a healthy move, right? 1.3% when the implied vols on this stuff are like 12. That's a very healthy move, and yet they're not bidding the vol. So the fact that the market makers are not bidding the vol and the vol is getting crunched lower is telling you that the whole street must be long, basically, right? So it kind of confirms to us, even though we managed to get a big day yesterday, or a reasonably big day yesterday in terms of movement, the implied vol price action is confirming to us that dealers are still long, and that suggests that that was probably a bit of a one-off, that move, and we are probably going to sit around and not do a lot still into OPEX next week. Okay, if we look at the S&P chart, you can also see, right, this congestion zone between sort of 4070 and 4200. That was kind of what we carved out in early February. We were chopping around in that range. We're now back in that range, and we have been chopping in that range for the last couple of weeks. And it does seem, you know, I realize it's fallen off a cliff, but this sort of zone on the S&P is one of congestion. And we suspect between now and next Friday's OPEX, there's not a lot of reason why we're going to break out of that range. Okay, the big strikes for OPEX are 4150 and 4200. If we look at the gamma concentration, this chart is from Spot Gamma. So, you know, a lot of things are backing up the view that we're probably going to struggle to move materially from here for the next week. Okay, so when we see that amount of evidence suggesting that the street probably is a bit stuck and a bit pinned, we bring out our expiry pinning playbook. And for those of you who've been following me for some time, you will know that tends to be some sort of iron condor structure that I bring out. All right, that's it for today, and have yourselves a great weekend, and I'll catch you all next week. Thanks a lot.